Welcome back. Let's not leave you without a three-stock lunch. Today, we're trading some of the big headlines, and Hightower's chief market strategist and CNBC contributor Michael Farr is here with us on how to position. Michael, welcome. We're going to start with some semis, which are taking a hit after China has reportedly urged local companies to stay away from Nvidia's chips. Nvidia shares are now down about 1%. They were down 3% pre-market. Not a big reaction, Michael, but what would you do with those Nvidia shares here?
Yeah, we don't care about the really what China's doing right now, and I think that the report by Kate was probably as important as anything on the regulation of the AI. Nvidia is a great company, and for now they're growing earnings at 40% per year, and they're 40 times earnings. You get a chance to buy Nvidia on pullbacks because the market is doing the same stupid thing with Nvidia that the market does with the Fed. They want it to be bigger than it is. They want these great earnings reports to even be better than they are. And when they come in only great and not greater and greater, the market, that stock trades off. So every time there's been an earnings on Nvidia, you've had an opportunity to buy it at about down 15%. I would wait, but I think it's one you probably want to own for a while. I've got it as a buy. Same thing with the Fed. When they actually do what they say they're going to do, markets get disappointed. I wish markets would listen better.
All right, let's move on to Carnival, Michael, down nearly 3% despite a beat. Shares are under pressure thanks to weak Q4 guidance. What are you doing with Carnival, if anything?
You know, their numbers were okay here in the earnings, but this is a really volatile stock. And here's the thing that really bothers me about this. This is a $23 billion in market cap stock with $28 billion in debt at Carnival, okay? They've got good EBITDA. They're trading at, single digits in terms of multiples, but it's very, very volatile. It's a ton of debt. They have very small room for error. I think if you're going to own something, I like Disney better. They're going to add 4 more cruise ships this year. It's much safer, much better balance sheet. Not that kind of debt. I'm out. I'd sell it on this strength.
And that's been a tough sort of weight to get out from under. In Carnival's case, I hear your point. Speaking of which, what about CVS? I mean, they're saying that major shareholder Glenview is planning with the company an activist push, and it's got the shares up 2.5%. They're down 20% this year. What would you do here?
Say uncle and sell it. Say uncle and sell it. CVS hadn't been able to get out of its own way, and I owned it for years and years and years. And so many things about CVS are attractive. There's 70% of the country of Americans live within 3 miles of a CVS. I mean, there's a whole lot as medicine changes, as healthcare changes, to recommend it. But right now, they just can't seem to execute. They've got problems with Aetna and the PBMs. When you look at these activist shareholder things over history, when they get involved, you get a temporary pop. It usually only lasts a couple of weeks, and it benefits the activist investor group much more than the average shareholder. So you get some strength in here. This would be one I'd sell, and I'd move on.